Thank you for joining us today. Like she said, we were going to start out with a little bit of technical information for you. If you have any issues during the webinar today, please contact Andy Cruz, that's A-C-R-U-Z, at communityactionpartnership.com, or you can call at 202-683-9091. If you lose your internet connection, you may still call into the conference. The necessary numbers are listed on the Event Info tab right here on your screen. There will be polls that will appear on the right side panel. Please, we enjoy getting your feedback and your participation in these, so please answer those polls when they do come up. If you lose track of any of your features, please utilize these tabs at the top to find them again. You may submit questions using the Q&A on the right side panel. Please send questions to the host so as not to disturb our presenters during the presentation. We will address questions at the end if time permits. We have a packed hour of information, so questions are likely to be limited.
Great, thank you, Cash. And as she mentioned, this webinar is being recorded and will be posted up on the Partnership's website under Resources sometime tomorrow, so take a look out for that information. In addition, in adding to the value of hopefully a webinar conversation with our trainer, we want to add an online discussion forum aspect to today's training. I hope that you'll visit the Partnership's homepage today, tomorrow, sometime before the end of the week, and visit our new discussion forum. If you go onto our communityactionpartnership.com website, there is a TNTA request system button that you can push, and you can register for our discussion forum. Under that discussion forum, there will be a financial management discussion tab, and we'll send a link out to everyone who's on the webinar on how to do this. And you can post questions that Mr. Mirren, our presenter today, will take time to take a look at and offer more in-depth answers to your questions. So again, we'll send you out some detailed information about that, but I hope you take advantage of our new online discussion forum before the end of December to post questions following today's webinar. Before we get started with the presentation, Mr. Mirren has started us out with a small poll to help assess some basic knowledge of some of the topics that are going to be presented this afternoon. We ask that you take this poll and answer the 3 questions on the right panel. So without further ado, as you complete this poll, I'd like to introduce our presenter, Mr. Kevin Mirren. Kevin is a CPA, Chief Finance Officer, and Vice President of Administration at Common Bond Communities, and the Treasurer of the Board of the Community Action Partnership for Washington and Ramsey Counties in Minnesota. Kevin, we're going to unmute you, and we're going to turn it over to you here. And looks like you are unmuted, so we'll turn it over to you.
Wonderful. Thank you very much. I know a number of people who would like to have the power to mute me all the time, so that would be a great Christmas gift for some people, I'm sure. Well, thank you for joining us this afternoon, and I think it's afternoon almost everywhere where we're talking today, except for out on the West Coast, I understand. Talking about budget bombshells, and even more broadly talking about financial analysis. And we use financial analysis both on the front end in the budgeting process and then on the back side when we talk about financial reporting. So specifically, what are we going to be talking about today? First of all, what is effective financial analysis? What does OMB A-110 require? So what is our choice and what actually is not our choice? What makes an effective budget? How can financial reports be an effective tool? And then finally, what are some key indicators? And certainly this will not be a comprehensive list, but just sort of touching the surface of what some key indicators might be. So with that, let's go ahead and get started and answer that first question. What is effective financial analysis? Financial analysis is extracting financial information to facilitate financial decision making. Well, that sounds like a mouthful, right? So specifically, what types of questions might we want to answer with financial analysis? Well, there are a number of them. I've thought of 5 and listed them here. Is the organization able to meet its short-term obligations? How about, can the entity afford to pay off its long-term obligations? Or can the organization survive a financial interruption? is the organization using its resources efficiently? And finally, is the entity complying with its contracted deliverables? We can be successful in this analysis if we make the financially prudent decision based on quantitative information. Now, that sounds more like a decision that GM or GE may make, and as a nonprofit organization, I really think part of the key is this part in terms of don't forget the stakeholders' needs, our mission, the employee morale of the organization, what's our image and brand, and then some of the strategic concerns. This makes nonprofits unique and actually adds an extra level of analysis. Once we can do the financial analysis, we have to answer some of these other questions as well. Before we start and dig into this, there's a few things we need to be very clear about. First, financial analysis is a science and an art. Frequently people say, well, that's the heart answer, or that's the bottom line answer. And I think someone who does financial analysis well is someone who can actually weigh and blend those two together and not just come up with one bottom line answer. Second, we need to remember there's really no one right way to conduct it. As it is an art form, we can use the science or the numbers to really get to our questions. Third, don't analyze the numbers in a vacuum. Numbers are not always comparable. I always think that numbers should provide a trigger for further questions versus numbers being the answer. They really should help drive the question. And then finally, you really need to know the environment. In other words, you need to know the general business, the local economy, etc. How things operate and what makes a successful entity in California may be different than in the heartland in Iowa. Or how we run a nonprofit may be significantly different than how we would run a large manufacturing company, or at least we would certainly hope so. As we look at this financial analysis, there really are two main types of analysis. The first is trend analysis, and the second is ratio analysis. First, let's take a little deeper look at trend analysis. Basically, trend analysis looks at results or financial numbers over a period of time. The benefits of trend analysis is it really does compare apples to apples. We need to make sure that the time period is long enough for a trend to be evident. In other words, two data points do not probably produce a trend, but rather are simply two data points. We also need to know the environment. We need to know what is happening in other similar organizations to ours and also other local type organizations. We need to know if there are extenuating circumstances, because numbers tell only part of the tale. We can't tell everything from just a page of numbers. And finally, a tool that I like to use is to actually take it out of the number arena and use graphs to help us analyze trends. Let's look at a very brief example of this. So it's pretty easy to have a page of numbers. You can see in the first column we have the year, we have total grant revenue, the number of persons served, and then to build context, it's the cost per person served, which in this case is simply this column divided by the number of persons served. So some people can look at this page of numbers and actually determine what that trend means, but I think it's much easier if we actually chart it out and look at it graphically. So looking at that first column, just the grant revenue, we can see that in general, once we draw in the trend line, that grant revenue, for whatever type of grant this is generally increasing and increasing pretty significantly. Next, let's look at that far right column and look at the cost per person. This produces a similar trend, and this chart really puts the numbers in context. And once again, if we drop in the trend line, we can see that the cost per person is generally increasing. Well, what does this tell us? Well, it depends on what question we're trying to answer, first of all. And really, to put it in true context, we need to know the environment, or we need to know the bigger picture. And to do that, we would use our cost per person, which is the gold bars, and in this example, comparing it to statewide average. This then produces some context. If we once again draw in those trend lines, we can see that the statewide average cost per person is actually decreasing. And we draw back in our trend line on cost per person, and we can see that our trend is increasing. So the conclusion we can make is that our cost per person is increasing while the statewide average is actually decreasing. That does not necessarily mean something is good or bad that is happening. Rather, it means that it would certainly set up a next series of questions to find out, are we serving people that are harder to serve than the statewide average? Are we doing a better job than others are, and are others doing it more rapidly and not doing and getting the results that we're trying to get? So those might be some of the types of questions that you might get from looking at this initial financial analysis. Of course, trend analysis can't provide the answer to everything. And a second tool that we use in financial analysis is ratio analysis. A ratio is, simply put, a relationship between two numbers. It is a comparison, and we may use ratios from the previous years for internal trends, or we may use ratios from others in the same industry as us to provide comparable data and comparisons. This tool might be used as a diagnostic to identify problems and opportunities related to such issues of outcome as financial liquidity, financial leverage, or the degree of debt in the organization, self-sufficiency, or just program efficiency. So what are some examples of ratio analysis? Some examples of ratio analysis are current ratio. This is current assets divided by current liabilities. This would help tell the liquidity of a particular organization. Days cash on hand. This also is a liquidity analysis and tells you how long you could operate without receiving additional cash. Days accounts payable owed. How long does it take the organization to pay vendors? Days expenses in grants receivable. How long does it take for the organization to collect grants receivable once they have been expended? Administrative expenses as a percent of total expenses. In other words, looking at our efficiency of spreading our administrative costs. Unrestricted net assets as a percent of annual expenses. This ratio would look at the overall long-term viability of the organization, as does debt service cost as a percent of total annual expenditures. How much control do we have over the assets that come in every year versus how much just is going to go out for pre-committed expenses? And a personal favorite of mine is budget to actual variance. I think that as we talk a little bit more, once we get into the depth of budgeting, I feel that it is important for financial people to be close on their budgets, and always just having some narrative excuse doesn't quite cut it. I always say that as a rule of thumb, a good financial analyst should be able to come within 2 to 3% on revenues and within 1 to 2% on expenses. Of course, there are always extenuating circumstances to this. So those are some of the uses for ratios. What are some of the limitations? Because nothing is perfect. Well, the first major limitation is that we're using the past to predict the future. What happened in the past may not be predictive of what happens in the future. And of course, anyone who's ever looked at a prospectus on any type of investment always sees that disclosure that's required by the SEC to say that past performance is not an indication of future performance. Same thing with ratio analysis. Secondly, there's no absolute correct number. Finding a comparison and a comparable is difficult, and trying to figure out exactly what to shoot for is a challenge. So once again, trying to come up with some specific goal is difficult. Usually, in ratio analysis, we try to attain some sort of range that we try to come in with. A third and very difficult to overcome challenge is that financial statements are based on cost, not fair market value in most cases. Of course, if we do decide to adopt international accounting standards, this could change overnight. Fourth, it's difficult to find true comparables. As we said earlier, when you're looking to try to establish what your goal is, you want to find what those comparables are in the marketplace, whether they're other nonprofits or other for-profits or whatever you're trying to compare to. But the environment in which those other organizations operate in may make them not comparable to your organization. If you have 50 employees and someone has 3,000 employees, it is probably very much a different type organization, and your ratios will not necessarily be the same. And finally, just like with trend analysis, ratio analysis should be the starting for the discussion, and it should not be the ends. It is one means to get to formulation of what the questions are, and then the follow-up and the answers to those questions really are key. So those are some of the general tools. What are we required to follow as part of OMB A-110? Now, this is not referring to the audit standards and not referring to the financial statements that we have to get audited, but rather OMB A-110 talks about the administrative requirements and what we're required to do to administer the grants on an ongoing basis. Subpart C, Part 21, gives us some verbatim quotes on what we need to accomplish. First of all, the recipients, or us as the nonprofit, must relate financial data to performance data and develop unit cost information whenever practical, like our first example that we looked at. Second, accurate, current, and complete disclosure of the financial results of each project. Next, source and application of funds. And finally, a comparison of outlays with budget amounts for each awards. Now, of course, with all those dots in there, it looks like I have distorted the meaning, which I hope I haven't done, but I have provided on this slide a more succinct analysis of not speaking in governmentese. What does it mean? Well, as I break down those requirements, to me, the requirements of OMB A-110 require that we use fund accounting, that we produce a minimum of an operating statement, that we have some sort of budget versus actual reporting, and finally, that there is some level of performance-based reporting or outcomes. And of course, this sounds a lot like ROMA. So specifically, as we look at budgeting requirements, and this slide is entitled Minimum Requirements, This is a Kevin minimum requirement. This is not in the OMB circulars, so there's no reference here in terms of what is required. OMB A-110 refers to the mandate to have a budget, but it doesn't really say what a budget is. So I'll give you my interpretation. There are, in my mind, 3 things that are absolute essentials for a good budget. First, that you have realistic inputs, or some people call these assumptions. In other words, garbage in is garbage out, and I think this is actually perhaps the most important minimum requirement. As I've often said, anyone can make a spreadsheet balance, but is it real? And when I review a budget with a board or a finance committee, I spend significantly more time talking about the assumptions and walking through the assumptions than I actually do looking at the financial numbers. The second minimum requirement is that it be fund-based. It is absolutely essential for us as nonprofits, and especially grant-funded nonprofits, that we tie revenues to expenses. We have to make sure that there are available revenues to cover the expenses based on their type. Not just that we could cover it in total, but we have to be able to allocate these costs back to specific funding sources, and we need to go through that exercise on the front. So I think that if people are doing budgets at a macro level or an organization level versus doing them on a programmatic or a departmental level, I think the process is not going to get its intended results. And finally, I will jump on my soapbox and flap my hands vehemently at this point, which I'm sure you're glad you can't see. It is important to use the results of the budgeting process. I have seen numerous organizations spend months and months and months developing a budget, and as soon as it's adopted by the board, it's never, ever looked at again. Besides being an incredible waste of time, I think this gets rid of a significant ability to manage the activity and conduct of the organization. A budget is only useful if it is actually used. And it's important that we compare budget to actual. Those being the minimum requirements, when I develop a budget or work with someone to do so, I have standards that go above that, and I think that these best practices, as I refer to them, probably because they're things I do, are actually really good practices for everyone. And I'm sure that everyone else has additional best practices besides this as well. First of all, I'm a huge advocate of monthly budgets. I think that doing an annual only budget misses a significant piece of the action. For people involved in Head Start, of course, those have program years that do not necessarily reflect 1/12 each and every month. So taking a budget and dividing it by 12 doesn't really give you a month-by-month anticipated results. Same thing with weatherization, and same thing with energy assistance programs. Letter B for best practices is accrual and cash-based. I think it's easier to do accrual-based budgeting without considering the cash flow impact. Of course, when we're actually operating the budget and operating our organizations, cash is king. And if the cash isn't available in a particular month or week that we need it, it's not going to allow us to run our organization effectively. And we should know that on the front side. And if there's a gap in cash flow, then we should find some other financing source, perhaps a line of credit, to get us through that trough to make sure that we can make it through to the end of our fiscal year. Letter C, multi-year projections. Some people also refer to this as modeling. Don't worry, this is not me in a swimsuit, because that would be terrible modeling. This is financial projection modeling. And we'll look at an example of this in a little bit when we look at some examples of this. I think it's important when we look at how an organization exists that a budget looks at 1 year, but really we're hoping that the organization is going to be around for the long term. So only looking at 1 year certainly does not give us a good picture of where the organization is going. Letter D, dynamic versus static. Many organizations, like I said before, will adopt one budget at the beginning of the fiscal year and then never look at it again. I'm a huge advocate of adopting policies on flexibility. How much flexibility does staff have, and where does governance step in terms of who can modify the budget, to what degree and to what extent. And then I think making mid-year modifications is a great idea. So for anyone to start preparing a budget 6 months before the end of the current fiscal year that then says their crystal ball is going to be accurate for the next 18 months through the end of the budget year is probably not telling the complete truth. And assumptions will change, realities will change from what was originally anticipated, and making those modifications and changing your plan is permissible. And having a dynamic budget that changes is not a sign of financial weakness, but rather a sign of good management. Fifth best practice, risk and mitigation planning. As I just mentioned, no matter how good you think you are when you start the budgeting process, something's going to change. Whoever would have predicted the 2008 credit crunch that happened, and who had that budgeted a year before it ever happened? I don't think any of us did. But trying to realistically assess what's out there and develop what your mitigation plan is to that, I think is an acknowledgement of strong management rather than weak management. Next, budgets must be ingrained in operations. What does that mean? Well, as I said, if a budget's not used, it's not very useful. So the budget must be communicated and understood. I don't think this just means with the president or CEO of the organization and the board of directors, but I think it's also important that the departments understand what their expectations are and so that they can be held accountable for that as well. I think some sort of ongoing, perhaps monthly or at a minimum quarterly, comparison of budget to actual on a department level, and that feedback going as deep into the organization as possible really provides the feedback that people like to see. Next is incorporating projections with budgeting, and this is basically just saying take it out more than 1 year. When we do our budgets, we do a 1-year budget with a 4-year projection, and we disclose on the front side we're not asking for approval of the projections from the board, but we do want to tell them if these trends continue or if the assumptions that we're aware of would continue and interact with us, this is where the organization would be. And it's important to disclose that and have that conversation, but we don't ask for approval for projections. Next, make sure the budget's reviewed at the proper level. The board level is different than management. In other words, not everyone needs to see the budget in exactly the same format. Of course, hopefully it's the same budget that you're showing to everyone, but perhaps it's presented in different manners or different level of details. And finally, pools must be monitored as well. Many people look at their grants and don't consider the budgets for administrative cost, etc., or space, etc. How these are going to be allocated and then monitoring them is an essential part of the budgeting process. And finally, ask questions. If the board approves the budget without asking any questions, it's not a sign of strength. Rather, I would say it's a sign of weakness of the organization. Encouraging questions and dialogue and getting common understanding of the budget is really important. switching gears slightly now and looking at effective financial reporting is the next item on the agenda. Just a few rules of thumb as we look at effective financial reporting. First, always keep the user in mind. There's a different level of sophistication. Internal program technical people, different directors or vice presidents, the CEO of the organization, and board members all have a different understanding, knowledge, and grasp of finance. So make sure that the level that you're reporting on is appropriate to the person receiving the information. Next, what will the information be used for? Form the question that you want answered before you start presenting the financial statements. Financial statements that we use for financial reporting to comply with generally accepted accounting principles and A-133 requirements are very structured, laid out, formulated, and formula-driven. That doesn't mean that that is necessarily the best format to answer management questions or board oversight or governance types questions. Don't get locked into a format just because that's what a balance sheet looks like. Report at the right level of detail. Of course, a board member will hopefully want less detail on the budget than a department head might want related to that same budget. Respect that and be able to present the information in multiple levels of roll-up. Something other than a page of numbers. So yes, I actually said it. I'm a CPA who really doesn't like numbers all that much. I actually like numbers, but I think there's value for things other than numbers, and I think things such as graphs and charts and words really can help put numbers in context. And as shocking as it is to me, there are some people who don't get into numbers and really have no interest and get turned off when they see a page of numbers. And having a little bit of color or something on a page really helps get them involved in the process. Financial reporting. What are the minimums? Well, as we already mentioned, from A-110, the minimums are operating results, so we need to report revenues and expenses. We have a requirement to compare budget to actual, and there's outcomes reporting. And I would say the overall driving factor in any of these is that all reports must be timely to be useful. It's interesting, in my old audit days, when you would see boards looking at financial information that was 3 months old. Of course, the organization could be out of cash and bankrupt by the time people are reviewing this information, and it would provide no benefit whatsoever. So make sure the information that's provided is timely. So a few examples of different formats. And once again, these formats are just one example. You need to make sure that you're assessing your own internal needs and that your format addresses those. So the first is an operating statement, and I would tell you that there is no such entity as Twin Cities Community Action. So we're not airing the dirty laundry of any organization that's out there. So keep that in mind. The key here is that this is fund-based by grant. So we have Grant A, Grant B, Grant C, and a second Grant C, which should actually be Grant D. Apparently I am better with numbers than I am with letters. And in this format, you can see that these grants are most likely reimbursement-based grants because they zero out at the bottom. The column that doesn't zero out is corporate or administrative, whatever you might call that in your particular organization. And that actually does produce a net revenue or a surplus number or net income if you refer to it as that. And this is just simply one example that would meet the A-110 requirement. The second requirement is that there be some sort of budget versus actual reporting. Now, as I mentioned, that I really like to do this on a programmatic or a department or division sort of level. that is not actually required by A-110. What is required is that there be some sort of budget versus actual comparison. So the highest level roll-up that would make sense is to do it on an entity-wide basis, and you could do a column that has actual, budget, and then I'm a huge fan of making some sort of comparison to actual and budget. One way to do that is to do actual as a percent of budget. You can do it as a variance versus with a percentage. You can do it with a variance as a dollar variance. There's a number of ways to do that analysis. The third required report is some sort of outcomes reporting. And I would say, looking at this example, the piece that's really not on here that should be is that this should be tied back to financial efficiency somehow. So in other words, when we look at units produced, we should, or this is enrollment actually for Head Start, we should actually look at how much are we spending per person as just one example. So you can break this down by the different programs that you have. In this example, this would be Head Start, and then look at what those key metrics or those key deliverables are. Enrollment, program enhancement, parent participation, just some examples. In my example here, I have monthly actual results, year-to-date, annual goal, and of course you could do annual and monthly goal. And then this column here is something that I like to use to get away from number comparison. So if people gloss over when they see how does 578 compare to 563, I use colored arrows. And actually each of these arrows indicates two things. So first there's green, yellow, and red, also known as traffic light indicators, that say green is good, yellow is cautionary or somewhere in between, red is bad or negative. And then the direction of the arrow shows the trend. So we have an up arrow meaning that the trend is improving from where it was last month or last quarter, depending on what the comparison point was. The double-ended arrow means that it's static or staying fairly similar, and the down arrow means that the trend is going the wrong direction. Then I also think it's important to have an action plan, and this is adding words to the discussion so that we can see what is the plan of action. And I think narrative is probably the best format for this. Those really are the three examples of minimum financial reporting for A-110. And once again, I would just emphasize that these are only examples. They're not exact formats, as there are really no exact formats for this type of reporting. So what if we want to go a step beyond what's minimum? What else can we do? Well, balance sheet, we can add a balance sheet. This tells us where we are. Statement of position, a financial position is the new wording for that as well. This would lay out assets and liabilities. Actually, this statement is not required in A-110. It's required in a single audit or a set of generally accepted accounting principle financial statements, but is not actually required in terms of ongoing management. How you couldn't use one of these, I would find very hard to believe. Things that we can add, as I've mentioned earlier, words, graphs, color, cash flow. Instead of just accrual-based, we could look at cash flow. And if we talk about what can we add, what can we get rid of? We can get rid of some of the detail. And one example of that is potentially exception reporting. So instead of reporting every line item that we budgeted just because we budgeted it, we can choose to omit some of that detail. And I'll show you an example of how that might be accomplished. First of all, a statement of financial position example, or a balance sheet, as the older terminology in the for-profit world refers to. includes a listing of our assets broken out into current and longer-term assets, then our liabilities, and finally our net assets. And of course, there are multiple different formats that you can do for this. This is a very simple, high-end, high-level financial statement of financial position, rather. This particular balance sheet B, is just an example that we use here at my organization. And just a couple of things to point out. I think one of the enhancements that helps is we have what the current period is, but also we have a point of comparison. This helps give us context. So we always compare our current point in time to the beginning of the fiscal year. A second thing that we do on all of our financial statements that go out to either the Finance Committee or the Board is we also include some sort of narrative discussion. And as you can see, it's very high level. It's not a discussion of each and every element. It's kind of things that I, as the CFO, might want to bring to the attention of someone looking at the organization. The thing I would add is I put the good and the bad in here, and I don't try burying the bad things and only tooting our horn, because any organization has challenges. Budget versus actual. Another version of that might be to just do it in narrative form. In organizations where I've seen this done, it typically gets rolled into a president's or a CEO's quarterly report to the board or monthly report to the board, where they may not actually present financial statements, but rather may present certain key level indicators in terms of what is happening with budget versus actual. Another example, and this one happens to be from my organization, budget versus actual. Here you can see that we have more numbers than before. First of all, I have it broken out into very, very summarized information. The target audience here is the board and or the finance committee, and I present only the highest level information. What might be 5 or 6 pages of detail that I look at on a summary entity-wide, and then each of the departments has their own statement as well. So our typical monthly financial package is probably 55 to 60 pages, and I squeeze that onto a half a page when I present the information to the board. Revenues, just 3 or 4 of our main revenue sources. Our expenses, I have listed personnel, operating, and other. And that is the exact detail that I break down those expenses. And then we have some non-operating items as well, investment gains on our endowment, partnership gains and losses, and we're in the middle of a capital campaign. So we break that out so that we can see how the organization is doing in total, but also how is the organization doing on an operating basis. So we don't want to include capital campaign contributions to run the organization or to pay day-to-day salaries, as they're really 2 different types of activities. You can see in the example here, there is some narrative on some of our major variances or major trends that I want to bring to the board's attention. I've included the last 2 years of information for comparative purposes. We actually had a 6-month stub period this last year. So this is 6 months. This is a full 12 months. And then this is the current quarter. So actual, budget, variance in dollar terms, and then also variance in percentage terms. Once again, not saying that this is the only way to do it. It is just one example, and it's after, this is probably about the 5th different format that this has taken in the last 2 years, and seems to get one little tweak every time we go to a board meeting. Another innovative way to present budget versus actual is actually not to have any numbers at all. In this case, we're using the blue bar as our indication of actual expenditures. The orange or brown bar as our indicator of what the budget was. And on the next page, we can see very quickly what are the two areas that we would probably want to ask questions about. Well, we might want to ask questions about the fringe benefits, which looks like actual is exceeding budget, and we may want to ask questions where the operating expenses are significantly less than the budget. So one question on what's going right, and potentially another question on what's not going so right. A grant status report is another example of an additional report that's not required. You can see in this example, what I do is list the different grants down the left-hand side of the page, and then the term of that grant, the total grant amount, the total expended to date, the remaining balance. The number that's in the colored box is just a percent of the dollars remaining, and then I do a very simple comparison of that to the percent of grant time remaining. Now, once again, there's always some story that may need to be told if you're not expecting that the percentages would be, 1/12, 1/12 for every month of the grant. This may not be a valid comparison, and you may need to find another denominator, which is certainly possible. You could do it as a percent of budget or budget period to date. And then what I do is add a little bit of color to show which grants are in good position. So grant A and grant D, the period of time that remains is less than the amount of money that's left. So we should be sitting in very good position for those. Grant B, indicated by yellow, we have 18% of the dollars left, but 25% of the time. We are going to need to pay some attention to this to make sure that we don't run out of money before we run out of grant period. And grant C, where we are really in trouble because we have 1% of the dollars remaining and 25% of the time remaining. I'm going to guess we're not going to be successful on managing this particular grant. I made reference earlier to exception reporting and getting rid of all the detail and getting rid of the pages and pages of numbers and having columns that must add up to another number. Another format that I've seen used with some success is a budget exception report. And in this particular format, all that's presented are things that would meet whatever the condition is. And so you would disclose the condition. The following exceptions are for budget line items varying more than 10% and $10,000 from either the prior year to date or the budget to date. So first of all, you'd go through and figure out which line items violate one of those two, and that would mean that it gets on the graph or on the report. You'd lay out the specific financial indicators of that, and then some analysis in terms of perhaps a reason why, and even better yet, what's the action plan to make sure that it gets better. This method is interesting because it strips out all the noise. How many times do we have people asking questions about office supplies or things that might have huge variances but be huge percentage variances, but be a very tiny, insignificant part of the overall budget? So enhancing the budget process. Specifically, there are three things that I use to do that. One is make sure we disclose the assumptions, which we've talked about a little bit, using projections, and then looking at cash flow. So just a few examples of some of these. This is from our actual budget document. The first page in our budget document is a disclosure of the major budget assumptions, not all of the budget assumptions, but a very high-level disclosure of those assumptions. Next is what I referred to in terms of our projections. In our case here, we actually have prior year actual audited numbers we have what our budget is for the most recent fiscal year, and comparing that to the budget that we're looking for approval for 2012 in the darker green. But I also go in and add a projection on where we think we are going to end up for the current fiscal year. So when our board in September or October is analyzing the budget, we compare it to prior year history, current year history, the projection, and where we were with our budget compared to actual last year. And then all of these numbers over here give us some of those percentages so that we can do analysis in terms of why there might be some changes or where are the areas to emphasize. Then I take it one step further and do multi-year projections. So in this example, we have the proposed budget, and then in blue, we have the next 4 years. And then down below, we have all of the major assumptions laid out for this projection. A final type of budgeting that I've mentioned or tool is looking at cash flow. The first example here is a very basic example of just doing, in pink are the projections for each month, and in the uncolored cells are the actual, so we can compare the budgeted to actual, and just looking at very high level. So the beginning cash balance, the receipts for the month, expenditures, and our ending cash balance, so that we can see how we're doing with cash. The monthly cash flow that we use internally is a little more complicated. These are just a couple of the months. This is actually a multiple page spreadsheet that goes deeper and has some pretty in-depth analysis that we use. The summary page for our board and finance committee, we use the detail pages for management to review. I indicated that we'd look at some key indicators at a very high level before we wrap things up this afternoon. And I think some of the financial indicators that we can get from our reporting are, we want to make sure we have an operating surplus, or at least not a deficit. Cash balance, a general rule of thumb is that it's great to have 3 months or 1/4 of a year for cash. Net assets, my rule of thumb is always that we should have 10% of our annual expenses in net assets. That we have diversified revenue streams to the extent possible. Accounts payable, we would want that metric to be 30 days or less. And of course, from an accountability standard, we would want a clean audit opinion. Key indicators for a good budget are that there are reasonable assumptions, there's no losses in reimbursement-based contracts, and that the administrative costs are covered or that we can allocate our costs out. And then I think it's important too just to look at system level indicators. So what are some of the key systems we want to make sure we have? Well, first of all, we would want to make sure that there is a lack of or outdated policies and procedures. Policies and procedures should be reviewed and updated. We would want the board to be engaged, not that we want them to micromanage, but certainly that we don't want them just to rubber stamp everything. We want to hear their expertise. Untimely financial statements or bank reconciliations is a key indicator that we have systems problems within the organization. Unaddressed audit or monitoring findings is another key problem. If we keep getting told to fix things and we don't, that certainly indicates that there are not appropriate systems in place. Tax filings, if those are not current, that is a significant challenge. And then if we have poor or no budgeting or planning process, also an indication that our organization will probably be in trouble. So thanks for paying attention to this last section. Now, just for fun, as we conclude, the following is actually a quote from an audit opinion. The auditee had material deficiencies in financial reporting. It did not maintain effective internal control over financial reporting and compliance with significant laws and regulations, and the financial condition and long-term fiscal outlook is continuing to deteriorate. If you look at the polling box on the right-hand side, you will see the question. The question is, whose audit report did this come from? Please go ahead and submit your answer. Enron, WorldCom, a local community action agency which shall not be named, a large East Coast state which we would also not name, or the U.S. government. And can we see the results from that poll to see what the results are? Maybe.
Momentarily.
Okay. And well, the majority of people who answered actually did have the correct answer. That is from the U.S. government's audit report. So they can tell us in A-110 what effective financial management is, but unfortunately they apparently can't do it themselves, unfortunately. So with that, I think our time is expired, and I will turn it back over to our host.
Thank you very much, Kevin. Appreciate all the great information that you provided today. We did have a very large crowd on the phone, which is one of the reasons why we didn't open it up to live Q&A. But as I talked about earlier on the conference call, we will be hosting an online discussion forum on our new Training and Technical Assistance website. If you go to www.communityactionpartnership.com, scroll down on your left-hand side, and you'll see an entry point for our T&TA system. And there is a discussion forum. You do need to register with the systems to get a username and password. And there is a special forum dedicated to Kevin's presentation. He'll be taking a look at your questions and posting responses. Over the next 48 hours, we will also be posting copies of today's PowerPoint presentation for you to download and put on file, resource later, whatever you want to do with them. So give us a day to do that, and that'll be up on the communityactionpartnership.com website. If you have any questions following today's webinar, though, please don't hesitate to give us a call or an email. Here at the partnership, our contact information is all up on the web, but you can reach me at dharlow@communityactionpartnership.com, and we'd be happy to forward you to the right person. Thank you again for attending today. Thank you again, Kevin, for a great presentation, and we hope to talk to folks soon. Hope you enjoyed today's webinar. Take care. Bye-bye.